Welcome back. This is Catherine Morgan-Nance. Part 3 of this video series on variable costing reviews two variable costing examples and compares the results to absorption costing. We reviewed this slide during our Part 1 video. Recall that the difference between absorption and variable costing involves fixed manufacturing overhead. Absorption costing includes fixed manufacturing overhead and product cost, while under variable costing, fixed manufacturing overheads are treated differently. They are accounted for as period cost, which means they're expensed in the period in which they are incurred, just like selling and administrative expenses. Before moving on, I have a question for you. We have just learned that fixed manufacturing overhead is a cost included in inventory values using absorption costing, but not under variable costing. Everything else being equal, which of the two methods produces the highest value for work in process and finished goods inventory? To answer this question correctly, recall which method includes more manufacturing cost in the per unit product cost. Absorption costing results in the highest inventory values because it treats fixed manufacturing overhead as a product cost. Under variable costing, fixed manufacturing overhead is expensed as incurred and never becomes part of product cost. For our next example, example 3, let's use the facts from our prior scenario where sales and productions are equal. Nothing has changed except we will consider the impact of variable costing on total product cost in the financial statements. Assume Arco Inc. produces and sells 25,000 units of a single product at a sale price of $30 a unit. Variable manufacturing costs total $10 per unit. Variable selling and administrative expenses are $3 per unit. Fixed manufacturing overhead for the year is $150,000, and fixed selling and admin expenses for the year are $100,000. Do you remember how to calculate fixed manufacturing overhead per unit using absorption costing? You divide fixed manufacturing overhead by the number of units sold to get how much? $6 per unit. Can you calculate how much the product cost per unit will be under variable costing? Pause the video for a moment to think about it before going on. We'll see how to determine variable costing unit product cost and compare them to unit cost using absorption costing next. As you recall, the unit product cost is $16 per unit using absorption costing and includes all variable manufacturing expenses of $10 a unit plus fixed manufacturing overhead of $6 a unit. The unit product cost is $10 per unit under variable costing because fixed manufacturing overheads are not treated as product cost under this method. As I mentioned earlier, different income statement formats are used to reflect operating results for each of the two methods. We'll see this in a moment. You've already seen the absorption costing income statement presented on the left side of this slide. We walked through it in the Part 2 video in this series. Now on the right side of this slide is an income statement prepared using variable costing and presented in the contribution format. Let's explore the contribution income statement as a brief reminder. In the contribution format, costs are grouped by the way they behave into variable and fixed expenses, regardless of whether they are product or period costs. Variable costs include all variable manufacturing cost and variable selling and administrative cost, and are subtracted from sales revenue to determine contribution margin. Fixed costs include fixed manufacturing overhead and fixed selling and administrative expenses and are subtracted from contribution margin to arrive at net operating income. And as a final point, the variable costing approach is not appropriate for external reporting. I'd like to call your attention to a couple important points here. As you recall, cost of goods sold is used to report the cost of the product that we've sold. In the absorption costing statement on the left, cost of goods sold includes both variable and fixed manufacturing cost of $16 a unit. When variable costing is used, as is illustrated on the right, cost of goods sold only includes variable manufacturing cost of $10 per unit. It excludes fixed manufacturing overheads. 100% of the fixed manufacturing overhead of $150 is reported as a period expense when using variable costing. This is the only dollar difference between absorption and variable costing methods. Under both methods, all variable and fixed selling and administrative expenses are treated as period expenses. Assuming this company sells all the product it produced, both absorption and variable costing methods produce identical net operating income of $175,000. On the other hand, however, if the number of units that sold in the period differs from the number of units produced, then net operating income will differ between the two methods due to the deferral of fixed manufacturing overhead into inventory. And we'll review that scenario next. In example 4, we'll change the facts and again prepare an income statement. Assume ARCO produces 25,000 units, but only sells 20,000 units. There is no beginning inventory, and 5,000 units are unsold and remain in ending inventory. The cost per unit calculations are still $16 per unit using absorption costing and $10 using variable costing, but you'll see that net income will differ between the two methods by the amount of fixed costs that are deferred in ending inventory. Once again, you reviewed the absorption costing income statement on the left side earlier in our Part 2 video. ARCO sold only 20 of the 25,000 units produced, leaving 5,000 units in ending inventory. At a sale price of $30 per unit, sales revenue for the 20,000 units sold is $600,000. As a unit product cost of $16, cost of goods sold for the 20,000 units is $320,000. And after operating expenses have been deducted, net operating income is $120,000. Now let's examine the variable costing contribution format income statement on the right side. First, we subtract all variable expenses from sales to get contribution margin. Using a product cost of $10 per unit, the variable cost of goods sold for 20,000 units is $200,000. The next variable expense deducted is the variable selling and administrative expense of $60,000, again based on units sold. After computing contribution margin, we subtract fixed manufacturing and selling and administrative expenses to derive net operating income of $90,000. Note that all $150,000 of fixed manufacturing overhead is expensed in the current period. The difference in net income between the two methods is due to how fixed manufacturing overhead is treated. Under absorption costing, fixed manufacturing overhead of $30,000 has been deferred. That means not reported as expense due to the existence of unsold inventory. So we have 5,000 units times $6 fixed MOH per unit. In contrast, all fixed costs are treated as period expenses under variable costing. And this slide highlights the reason some managers employ variable costing to explain results. Managers want to evaluate whether a company generates enough contribution margin to cover fixed costs as they arise. Using variable costing, they can immediately see the impact fixed costs have on the organization's profitability because there's no opportunity to defer fixed manufacturing costs to future periods. Important, remember, when the unsold inventory is sold in the future, these costs will be released and reported in cost of sales, and net income under absorption costing will be lower than it is under variable costing. We'll see this situation occur when we look at the year 2 results in our final video. But first, I'd like to walk you through the cost flows associated with the two methods. 3 accounts illustrate the impact on the financial statements due to the difference in the way the costing methods treat fixed manufacturing overhead. The impact is especially visible when units produced differ from units sold. Those 3 accounts are inventory, cost of goods sold, and fixed manufacturing overhead. Note that we will be accounting for $400,000 in manufacturing costs split between $250,000 in variable cost and $150,000 in fixed expenses. So under absorption costing then, inventory of $400,000 is produced. That's 25,000 units times $16 per unit product cost. When the inventory is sold, $320,000 is transferred into cost of goods sold with a debit, and inventory is, of course, credited. The remaining balance in ending inventory then is $80,000. That's 5,000 units times $16 a unit. Total manufacturing costs that we've accounted for now equal $400,000. That's $320,000 in cost of goods sold plus $80,000 in ending inventory. Now, under variable costing, inventory of $250,000 is produced. That's at $10 a unit. $200,000 of inventory is sold and transferred into cost of goods sold. We debit cost of goods sold, credit inventory for 20,000 units times $10. The balance in ending inventory is $50,000, which is 5,000 units times $10. Total manufacturing costs under variable costing are found in three accounts: the inventory account for $50,000, the cost of goods sold account for $200,000, and the fixed expense for manufacturing overhead of $150,000. So we've accounted for now the same $400,000. Those amounts just exist in different accounts. Notice for a moment that total expense reducing net income under absorption costing is $320,000. That's cost of goods sold. But total expense under variable costing is $350,000. That is cost of goods sold plus fixed manufacturing overhead. The difference of $30,000 is equal to the amount of fixed manufacturing overhead deferred in unsold inventory under absorption costing, 5,000 units times $6, and we can see this difference in the ending balance in ending inventory, $80,000 in absorption costing versus $50,000 under variable costing. Please note that this difference will reverse itself. The cost deferred in inventory will be released, in other words, when the number of units sold is greater than the number of units produced and inventory quantities decline. Now, let's take a moment and look at these manufacturing costs in a different format. This slide shows another way to think about the differences between absorption and variable costing. Here we simply categorize the $400,000 of manufacturing costs as either product or period costs. Under variable costing, the entire $150,000 of fixed manufacturing overhead is treated as a period expense. However, under absorption costing, the fixed manufacturing overhead is located in two accounts. $120,000 is accounted for as an expense in cost of goods sold, and $30,000 is deferred in ending inventory as an asset on the balance sheet. As a result, the variable costing ending inventory is $30,000 less than under absorption costing, and net income is also lower by the same amount. The difference in net operating income between our two methods, that difference is $30,000, can be reconciled by multiplying the number of units in ending inventory, 5,000 units, by the fixed manufacturing overhead per unit of $6 that is deferred in ending inventory under absorption costing. Note that in the long run, when more units are sold than left in inventory, cost of goods sold will be higher under absorption costing and profits will be lower. But, and this is important, profits reverse themselves over time. This is because over an extended period of time, sales cannot exceed production, nor can production exceed sales. I hope that makes sense. The shorter the time period, the more the net operating income figures will tend to differ. and we'll come back to this idea in the next video. See you shortly.